A quick thesis, why are we having these classes? And what I try to look at in history is what are the biggest and most important takeaways from any time period. Now, this is sort of a ridiculous task for the period of the Depression and all the financial regulation that came about. But there's no one better to do this with than Dick Sylla, who I'll turn it over to in a second. I think the way I do it is try to break out this sort of whole policy questions into four different areas. One is, how can we fight recessions? How do the government fight recessions from a fiscal policy perspective? Spending. Did we spend our way through all the New Deal policies out of this recession? Number two, monetary policy. How did the Fed, because we had a central bank back in the picture. We didn't in some of our other classes, but we have a central bank. What was their monetary policy, their interest rate policy? Was it good or was it bad? What lessons can we learn? Third, bank regulation, federal bank regulation came into effect to create a stable commercial banking system. Did it succeed, and what side effects are there that we should be looking for today? And then the last one, security markets regulation. So without any further ado, I'm going to turn it over to Dick Sylla. Dick, thank you so much again for doing this. And I guess Dick will talk for about 40 minutes or so. We might ask a couple of questions, as Taylor said. And then at the end of the hour, we'll certainly open it up for questions. And you can pose questions at any time in the chat. But if we're on time and on schedule, we'll open it up for questions if you have any about what's happening today in the financial markets and anything else you'd like to ask Dick. All right, over to you.
Thank you, Jan, and greetings to all of you dedicated people who probably stayed up too late last night. So if you need to nod off while I'm talking, you can do that, and we'll all understand. I may nod off myself, I was up a little late last night too. So I thought, well, before we start, our financial world today, a lot of the parameters of it were set back by the financial reforms of the 1930s. And let me just mention two that have been considered the greatest accomplishments of the New Deal financial reforms. One is deposit insurance. And if you go back and read Milton Friedman's and Anna Schwartz's Monetary History of the United States, written in around 1960, they actually said that FDI deposit insurance was perhaps the greatest achievement of the New Deal because it made the banking system safe. We had a very, as far as people who put their money in banks were concerned, bank failures sort of went away, and people didn't lose money if banks did fail. So I think that was when I was young in the 1960s, studying Friedman and Schwartz, that made an impression on me as an accomplishment of the New Deal. But then by the 1980s, deposit insurance was being questioned. We had the savings and loan crisis, and some banking, the Continental Illinois Bank failed, and the deposit insurance schemes basically protected depositors, but maybe perhaps people said created a moral hazard in the banking and savings and loan business by making people not pay much attention to what their banks were doing with their money. So I would say that for 30 years after the New Deal, deposit insurance was considered a great achievement. And we had some questions about it in the 80s and 90s. But I would say still today, we all feel good that our money in the banks is, no matter if the bank fails, the government is insuring our deposits up to a fairly hefty level now. Was it 250,000 or something like that? It was a lot lower in the New Deal, but it was gradually raised over time. The second thing I think I would say was, and this was not really appreciated at the time, in the 1930s. In fact, it was rather resented. And this was securities regulation. The SEC came in the 1930s, and Wall Street hated it. People thought, that it was just on the road to socialism, government interference, and free markets. And But over time, today we have probably the most vibrant capital markets in the world. They're not perfect, we know, but there have been a lot of problems. But the U.S. has these great capital markets, and I think some of that goes back to the securities regulation that came in the New Deal, which basically, with a lot of the provisions, we can come back to them, talk about them, but basically the disclosure of information. There was a lot of asymmetric information, and to use the economics jargon, in the old securities markets, and that allowed a lot of sort of misbehavior, and people didn't have much information. I always like to think about, I have a first edition of Benjamin Graham's and David Dawes' security analysis, which came out in 1934, the same year that the SEC was created, and but it was probably written in 32 or 33, and they talk about, it's kind of really hard to get information, but there is information there if you really work for it. You can study, some companies issue some reports, and there are other, you can look at the behavior of the price of the security itself. And, it's hard to get information about what securities are valued, but if you work hard, you can do it. And I'm thinking right at the time Graham and Dodds' first edition said that, the world was changing in the sense information which would become much more available. So I would say, after mentioned the deposit insurance, but I would say SEC regulation, which was thoroughly tested at the time by Wall Street. Over time, people came to appreciate it because it gave investors a lot of confidence in our capital markets, and I think they thrive because of this New Deal securities reforms. I think to start off the substance of what I want to say today, I've created a bunch of slides which I think were mailed out to you. I might run through a few of these. This is just shows you, this is from 1869 to 1990, I guess. And what you see is the steady increase of output in the United States, except for this period from the 1930 to 1945, roughly, where you see a huge collapse. That's the Great Depression. And then there's a recovery, a little bit of a hiccup in the recovery in 1937, 38. And then World War II comes in. So what you have in this kind of unique period of US history is the biggest sort of departure from on the downside from the long-term trend growth of output in the United States. And then sort of World War II brings a dramatic recovery, which gets us way above trend. And then as we demobilize after the war, we get back to the trend. And so this is the period we're talking about, the biggest disaster in US history, I would say. If you go on to the next slide, I just want to run through some of these quickly. And I would say this next slide, if you look at these are real GNP. We used to talk about GNP. Today we talk about GDP. But what you see is it falls 25% basically from 1929 to from 104 billion down to 74 billion. That's a real GDP. So it's kind of 25%. Well, maybe more than 20, maybe 25 to 30% collapse in real GDP. And look over here, what happens to investment. Investment is viewed often as driving the economy, healthy investment in the 1920s. Then 1930 isn't so bad, but then gross investment in the economy almost disappears by 1933. Who wants to invest when nobody's buying things and everybody's unemployed? So that was a big problem. So there's a collapse of the output of the economy. And then maybe we can go to the next slide. The money stock, this is what Milton Friedman basically claimed, that the reason that the GDP fell as much as it did is that the money stock, which was the M2 was the one, his favorite one. In 1929, it was $46 billion. And by 1933, it's $30 billion. So you get, what is that? It's a 15 billion decline. So it's something like a third. The money supply collapses by a third. If you look at the long sweep of US history, the money supply hardly ever goes down. It may level off for a period in a recession, but it hardly ever goes down. And from 1929 to 1933, the money stock collapsed. And the reasons for it were, in 1929, this is the deposit reserve ratio of the banking system. In 1929, the banks created $13 of bank money for every dollar of reserves they had. By 1933, they were making only, let's see, what is it, the 10 and then 8. It goes down actually through the whole 1930s. Bankers were shell shocked by this economic collapse, and they kept holding excess reserves through this period. And they're down to, by 1939, at the end of this depression decade, they're creating only $3.7 of money for every $1 of reserves they had. So the bankers are really shell shocked. The public, of course, this is deposit currency ratio. We divide, I have some currency in my pocket and I have bank accounts. And so I hold my money in those two different forms. And what you find is that in 1929, the public held $11 in bank money for every dollar of currency they had, base money. And by 1933, after the banks were failing, the people pulled their money out of banks. They were holding only $5 of bank money for every dollar of currency they had. And then there is a bit of recovery. This is Franklin Roosevelt. One of the things he did was restore some confidence in the banking system. He didn't make the bankers more confident. They continued to be contractive and holding excess reserves. But the public actually, when Roosevelt had his fireside chats and said, we're reopening the banks that we closed, and if we reopen a bank, you should feel safe. And of course, he was basically introducing the idea of deposit insurance, which was created by legislation after he fireside chat said you can trust the banks from now on. Shortly after he fireside chat, Congress passed the Glass-Steagall Act, which brought in federal insurance of bank deposits. Let's see, the next slide is the price collapse, I think, if we can go on to that. Just look at the GNP price index. That's an easy one to follow here. It's 100 in 1929, and it's 75 in 1933. So prices went down 25%, perhaps a little more on the wholesale and consumer price index. This is so we had GDP going down, investment going down, the money stock collapsing. Now we see prices are falling. This is deflation. And of course, a lot of debts were not indexed, so it became harder to repay debts with this collapse of the price levels. Take farmers. Farmer might have sold his. Let's say a farmer sold his wheat for $100 or $10, or $1 a bushel in 1929. And it borrowed money based on selling wheat at $1 a bushel. Well, by 1933, he's getting 75 cents a bushel. It's hard for him to repay his loans from the bank. All right, the next chart is about unemployment. There's a couple of.
Dick, can I just we have a question here.
Sure.
Maybe going back. How is money created? If you were, yeah, that's the question. How's money created here?
Well, basically the Federal Reserve, Milton Friedman called it high-powered money, but the Federal Reserve basically creates money with the stroke of a pen. So what does the Federal Reserve do? It goes out and buys securities, which gives people more money. And that's creating high-powered money. And then that gets into the banks, and the banks can lend out more money. That's why some people are worried a little bit. It hasn't shown up yet much, but the inflation might be around the corner. The money stock this year was year over year in recent months. It's been up like 20 to 25% compared to a year earlier. And historically, those rates of increase in money of 20 to 25% forecast inflation ahead. We haven't had it yet, but some people think it will happen. So anyway, the Federal Reserve sort of creates base money, and then the bankers expand it into a lot of through bank lending into bank money. And so we basically have two kinds of money: base money, which is the currency in our pockets and the bank reserves at the Federal Reserve, and then the bank deposits that we have, demand and time deposits. So the Federal Reserve creates the wherewithal to create more money, and then the bankers and the public together create more money. And
there's a sort of multiplier effect, right?
I mean, if the Federal Reserve creates $1 of reserves, I think today that can lead to an expansion of money by $2 to $3, something like that. So the banks magnify.
what was happening here is that multiplier effect was going down because the bankers were too.
Oh yeah, the banker. Here you see the collapse of money. The banks are making fewer and fewer loans for every dollar of reserves they had, and that continued throughout the 1930s. The public distrusted banks, especially from 29 to 33, where they would hold, in 29. That what I said, they're holding $11 in bank money for every dollar of base money currency, and by 1933 they only have $5. Well, this is partly because their banks failed, but it was also because people drew a lot of money out of banks. They distrusted the banking system.
Let's go
Uh,
forward.
to those charts on unemployment, they're ahead. There's you see the unemployment rate 1932 33 is between 22 23%, something like that, and it's it was much lower after the depression. We never got back up to those levels. I guess by the 1982 we were up to close to 10%, and of course in the global financial crisis of a decade ago we were up around 10%. But the 30s were really a terrible collapse when unemployment got to above 20. So some people say it was actually 25% in some months there in the early 30s. The chart, the next chart is just showing how much unemployment went up. This is the actual number of workers. About 1 million people were unemployed in 1929. Some people are always unemployed because they're leaving one job for another one. And by 1933, about almost 12 million people were unemployed. And that was something like 20 to 25% of the labor force was unemployed. Of course, there are unemployment compensation programs as well to give unemployed some money when they're involuntarily unemployed. And then there's a strong recovery from 1933 to 1937. And then there's that recession, 1937, 38, when unemployment goes up again. That's the blip that we saw in the chart where the strong recovery gets interrupted. We might want to come back and say, how did that happen? And then you're getting close to, by 1939, actually in this period, the Europeans, the French and the British suspect that Hitler is going to do something bad. And so they're sending a lot of orders to the United States to buy military equipment and all that. And that's part of the reason why our economy is recovering going into World War II, and we don't get into World War II until end of 1941, but there was still increase in spending related to the war before the U.S. actually gets involved in it, and that relates to Europeans spending money in the United. Partly, there are other reasons as well, but the Europeans are spending money to buy military supplies in the United States. And from 39, of course, the war is actually taking place from September 1939. Let's see, that may be, I think from now on, the charts are, well, maybe we could go ahead a couple of more charts, Jan, if we could. Well, let's take a quick look at the next chart. This is the money stock. The earlier data, this is just sort of what it looks like if you chart it, and these are log scales, I think, so it doesn't look like a dramatic drop, but when you realize it's on a log scale, it's a decline. These things hardly ever go down, but they went down a lot then. And here's the public holding more currency. They distrust the banking system. That's a sign of that. Next chart. Let's see, industrial production. This is the 1929, 1933, a big collapse in industrial production. The prices, we saw that personal incomes are just, headed straight down in this period. So we saw it in numbers before, and now we're seeing a picture of it, prices collapse. Now the next chart is one we might want to spend a little time on, especially at the bottom here. This is the discount rate of the Federal Reserve System in this collapse of 1929 to 1933. What you see here, call attention to the fact that in, I think it was September 1929, the Federal Reserve raised its discount rate from 5 to 6%. This was when they were worried about speculation, a lot of speculation in the stock market. And of course, less than 2 months later, the market crashed, but it started going down right at the time. Could I make the chart a wee bit bigger? I can't really do that here, but I think you got this chart this morning in an email. I guess, that's a little bit bigger. Anyway, this is a 5 to 6%. Yeah, there we go. Got to go back to the previous chart though and get down to the bottom. Whoops. It's down at the bottom of this. This is kind of Fed policy. So then when the market crashed, the Fed did reduce its rate, but only back to where it had been before. Somebody's telling me I can use my Zoom function. I don't really know how to do that. But anyway, I think you can see what's going on here. There's a 5% discount rate of the Fed up to 6%. Market crashes, rates start coming down, and they keep going down. This looks like the Fed is fighting the decline. But really, other rates are going down. Here's commercial paper. So the Fed is not really, it's basically, what do we say? It's behind the curve. It's not making things better. It's just sort of reflecting what's going on in the economy. And of course, even though the Fed is reducing rates, less than perfect credits, like these are BAA bonds, 1930 to 1932, they go up quite a bit in interest rates. Ben Bernanke talked a lot about this, the credit problems in the Depression, that it became hard for businesses less than prime to get credit. And the Fed, keeps reducing the rate, but I say it's behind the curve. Now, here's an amazing thing. By 1931, the economic situation is pretty bad. And when the Depression is really getting bad, and then you see in September, October 1931, the Federal Reserve raises its policy interest rate from 1.5% to 3.5% in a very weak economy. Now, can anybody in the class tell us why the Federal Reserve did that? In a really weak economy, it more than doubled its policy interest rate.
Put your answers in the chat, please.
Right.
So why did the Fed raise rates in 1931?
Yeah. Well, let the professor help them a little bit. I mean, basically, the U.S. is on the gold standard then, and Britain went off the gold standard. In Europe earlier in 1931, in May and June and July, Austria and Germany left the gold standard, and other countries on the continent of Europe left the gold standard. Britain was still, at that time, considered one of the major world economies. The British Empire is still intact, and Britain is a pretty, well, it's not such a strong economy. But anyway, it leaves the gold standard, and the U.S. then, when you can't get gold anywhere but America, people come and try to, liquidate securities with dollars, and then get the U.S. is committed to the gold standard. So the U.S. starts to lose gold, and the Fed is worried about the U.S. losing gold. Maybe the U.S. won't be able to maintain the gold standard. So it raises interest rates a lot to try to prevent the U.S. from losing gold. And that's just the wrong thing to do in a Great Depression. And that made, I used to tell students, I'll tell you guys, that probably made 1932 the worst year in U.S. economic history, in the sense that 1932 is when you had that very high unemployment and all that. Now, here's another thing. So the Fed reduces rates a little bit, but they don't get back to where they were. 1932 is a pretty tough year in the economy. Then in early 1933, something very unusual happens. Somebody is saying, Keith is saying, didn't the government also raise taxes? Yeah, there was a tax increase in 1932. That's a bad idea in a Great Depression as well. The Revenue Act of 1932 was not well thought out. But the Fed now is raising rates again in early 1933, and this is because there's really a raid. People are not only going to their banks and taking their money out of banks, forcing the banks to close, but people are actually coming to the U.S. Treasury with dollars and asking for gold. It's a run on gold. It's not just a run on the banks to get U.S. government currency, paper dollars and coins. They actually came and started taking the gold away. So the Fed had to fight this loss of gold. In general, the economic historians say that it was the commitment to the gold standard that made the Depression as bad as it was. And these are examples of it, when the Fed is raising interest rates to protect its gold stock in the worst economic decline in U.S. history. And these increases in interest rates by the Fed contributed to that decline. So that's people say that that's a bad part of the.
But Dick, wasn't part of the reason that people were pulling their gold because they thought that FDR was going to confiscate it?
Oh, that's right. There was a lot of, Congress and politicians in late 1932 and 1933. I mean, the politicians were actually onto something that economists believe now. They thought the gold standard was causing a problem. So they started discussing, maybe we should get away from the gold standard, which other countries were doing. And that caused people to say, oh, well, we might, go off the gold standard. We better run and get as much gold as we can right now. So that, that political discussion about leaving the gold standard, which was not unique to the United States, other countries were doing it, but the United States was still trying to convert dollars into gold coins, and there was a run on the gold stock, and so that's not going to last very long because FDR is going to take the domestic U.S. economy off the gold standard quite early in this. In his term, he gets inaugurated on March 4th, 1933, and the Fed just before that is raising interest rates to protect its gold stock. And of course, these rises in interest rates in this collapsing economy are just the wrong thing to do. So Jan at the beginning said we should talk about monetary policy. Well, here the monetary policy is just, was not very good policy at all. And it's because they were trying to protect the gold standard instead of protecting the economy and the unemployed.
Just one other thing that just as a comment. I mean, I really love this slide, and that's definitely this is one of the crimes, right? The policy crimes of.
Yeah, I mean, central banks can make mistakes, and we look back on this now. It may not have been a mistake to try to slow down speculation by raising rates in 1929, but certainly this 1930 September, October 31. More than doubling of the Fed's discount rate in a very weak economy was just the wrong thing to do. And in 1933, when the Fed raised again, that's, it's protecting its gold stock. Meanwhile, the banking system is going down the tubes. It reminds you of that famous thing about Vietnam. It was necessary to destroy the village to protect it. And that's kind of what the Federal Reserve, it's protecting the gold standard and helping to destroy the economy. All right. Well, so that's, a flavor of the decline of the Depression. And now I want to talk what the response was, in terms of financial reforms. And I'll just mention a few. There's a slide at the very end, which you won't be able to read on this screen, but maybe if you blow it up on your own screen, the very, it's the very last slide. It's just a list, and I'm going to run through it. It's a list of the these are the securities reforms, not just in the 30s, but all the way from the beginning of the century into the 1970s. But let me come back and talk about both banking and securities reforms, and maybe you can show my pretty face for a while now, unless we can come back to that. Okay. So now, what was the response? So the economy has really tanked, and the Federal Reserve is doing the wrong things. And it was wrong, as Keith pointed out, to raise taxes in 1932. That's bad policy. But what does Roosevelt do when he comes in? And first thing he's inaugurated on March 4th. By the way, February night, you should go back and read about February 1933. It was really an interesting month. Various states are shutting down their banking systems. In Washington, D.C., the Senate Banking Committee is having hearings on how Wall Street caused the crash and the Depression. And a man named Pecora is grilling bankers, and he finds out that Halsey Stewart in Chicago was hiring a professor to read scripts for it on how they should buy Insull securities. That Samuel Insull was a big public utility holding company, and he was buying up utility systems by issuing a lot of bonds through Halsey Stewart. And Halsey Stewart hires a professor from Chicago, supposedly a objective guy, to read a script and say, these Halsey Stewart has these great Insull utility bonds. And the Senate, Pecora gets Stewart, the Harold Stewart, I think his name was, to testify to the fact that, yeah, they did that. They hired a professor to read scripts for them, making the public think these were great investments. The professor says so, when in fact it's Halsey Stewart. And they didn't tell the public they did that. And then they bring in Charles Mitchell, the head of Citibank, and they find out that he was doing a lot of self-dealing and things like that. He testifies about February 21st to 1933, and a week later he is fired by Citibank. So the head of one of the country's most prominent banks is basically taken down by congressional hearings. And then, right before the day, actually the night that Roosevelt is going to be inaugurated, the next day, the governor Lehman of New York, Herbert Lehman, shuts down the New York banking system, and basically most of the country's banking system is shut down. So February 1933 is very interesting. Roosevelt comes in on March 4th. On March 6th, he issues an executive order closing the banks of the country, all the banks. Most of them were closed already, but Roosevelt comes on and shuts them all down. This is what's called the bank holiday, the day the money stopped. And the banks are all shut down. People go and inspect them. Many of them never reopen, but gradually about 14,000 banks reopen. There might have been 20,000 banks or so, maybe more than 20, maybe 23, 24,000 banks. They're all shut down. About 14,000 gradually reopen. That's when Roosevelt makes his chat on the radio saying, if we reopen a bank, you can trust it. And then the public starts putting their money back in the banks. They like Roosevelt. Then on the 9th of March, 5 days into his term in office, Roosevelt has the Emergency Banking Act, which gives him the authority to nationalize gold holdings in the United States. And it has some other provisions, but the key thing was Roosevelt announces that he's going to nationalize gold, or he's given the authority to do that. On the 10th of March, a day later, Roosevelt prohibits gold exports. It's the end of the gold standard. Americans, and he's in the slideshow, there's a proclamation that Roosevelt's going to make in April, basically telling all of Americans to take their gold and bring it into the government and get bank deposits for it instead. So, and then the gold is taken and put in Fort Knox, Kentucky. This is the end of the gold standard domestically in the United States. Internationally, we try to maintain it through the Bretton Woods system until the 1970s, when Nixon ends the Bretton Woods system. Then the gold standard is gone, and it's been gone ever since. Now, in the 27th of May in 1933, this is in Roosevelt's 100 days, we get the first Securities Act. And what it says that if you're going to sell securities to the American public, you have to register them with the, I think this Federal Trade Commission then, because there is no SEC, but the SEC will be created, and a year later, you have to register with the Securities and Exchange Commission. You register the securities, and you have to disclose with a prospectus what anything that might help an investor figure out what securities are worth. This is the beginning of modern securities regulation. This only applies to new issues. So that's May 1933. In the 5th of June 1933, Congress passes a joint resolution abrogating the gold clauses in contracts. A lot of bonds and other contracts said, this contract's written in gold and you have to, pay gold for it. Now they've nationalized the gold, so people don't have, or they're going to nationalize the gold. So people they're in the process of nationalizing the gold. What are you going to do if you have a contract that says this has to be paid in gold? The government's taken all the gold away from you. So Congress, through a joint resolution, abrogates any gold clauses in contracts that say, you must pay in gold. This is going to go to the Supreme Court, and it's going to be upheld. So that's in June. And then on the 16th of June, 1933, we get the Banking Act of 1933, the so-called Glass-Steagall Act. And what it does is brings in deposit insurance. It calls for an FDIC to be created. In the meantime, deposits will be insured in another way. It prohibits interest on demand deposits and regulates interest on time deposits. So the banks now, the reason for this is that when the banks were paying interest on demand deposits in the 1920s, since they had to pay this interest, Senator Glass from Virginia said, well, having to pay interest means the banks have to go out and take more risk. And that's how we got into this mess. So let's prohibit the banks from paying interest on demand deposits, and let's regulate at low levels what they pay on savings deposits. This is to make the banks safer, according to Glass. What else did they do? They separated commercial and investment banking. Glass had this idea that banks like Citibank and Chase and so on that had securities affiliates in the 1920s, uh, the combination of investment banking and commercial banking in the same institution had conflicts of interest and was risky, and that's why we got into this depression. And so the way to get out of it is to separate commercial and investment banking. And the banks had to choose what they would do. JP Morgan chose to be a commercial bank, so some of its partners split off to form Morgan Stanley as a result of this legislation. And so that lasted until the 1990s. It was repealed in the late 1999. Glass-Steagall separation of commercial and basic and investment banking was repealed not so long ago, 21 years ago. This allowed national banks to branch according, branch banking was a real problem in American history. We're used to it today. We think there's no real restriction on branch banking, but for much of US history, banking was strictly regulated. They didn't like branch banking. The small banks didn't want other banks in the big cities to come and open a branch next door because they thought it would be hard to compete with them. So they passed state laws saying, like in Illinois, where I grew up, a bank could only have one office. In other states that were more liberal, maybe you could have a branch in the same town or the same county. And a few progressive states like California and North Carolina allowed statewide branch banking. But in many states, especially in the center part of the country, a bank had to operate from one office. It's called unit banking. Well, the national banks got to open branches to the extent state banks could. So those are the big thing. And, we think of this as, Wall Street might say, or the banking system might say, oh, the government is really cracking down on banking here. But in fact, if you study the way legislation is made in the United States, there were beneficiaries of all these things. The big commercial banks that used to compete with each other by paying money on demand deposits now had the government prohibit that. So this was a nice way of, the big banks like that. The government tells us we can't pay you any interest on your demand deposit anymore, your checking deposit. So that's just fine. So that, the big banks like that. The investment banks like the fact that the commercial banks like Citibank and Chase would no longer be able to compete with them. And deposit insurance, which is part of this act, protected the small banks, which could go on. They had suffered a lot there were a lot of bank failures. One of my tables shows you there were like thousands of bank failures in these 4 years. And the small banks are really worried about failing, so they thought the deposit insurance would help them to stay in. So this Glass-Steagall Act, which seemed to crack down on the banking system, actually had some benefits for most of the people that were parties to the legislation, you might say. Then we go to 1934. This is after the 100 days now, but everything I discussed up to now, the banking holiday through Glass-Steagall, is in Roosevelt's 100 days of a lot of legislation and the beginnings of security regulation. In early 1934, you get the Gold Reserve Act, which devalues the dollar to 59% of its previous value. Basically, $1 was defined as about 1/20 to 21st of an ounce of gold, 1/20th of an ounce of gold, up to 1933. And after 1933, a dollar was 1/35th of an ounce of gold. So you reduce the gold content of the dollar. Americans weren't using gold anymore because the government has nationalized gold. But the $35 an ounce for gold, internationally, the US under Bretton Woods guaranteed other countries would be able to convert dollars into gold at $35 per ounce. So this is a devaluation of the dollar. Probably a good thing because it led to an inflow of gold in the United States. Suddenly foreigners could get more dollars with their gold. And so with an ounce of gold, you suddenly are able to get $35 and prices are low because of the price collapse in the US. So one of the reasons we had an expansion after 1933 is a lot of foreign gold began to flow into the United States and increase American money. Now, I guess the last one we'll mention, there's some other ones we could talk about, but in the interest of time, the 6th of June, 1934, you get the Securities Exchange Act. And what this does, the 1933 Act that I already mentioned said new issues of securities had to provide a prospectus and register. Now, all existing securities have to register. And this is when we get companies have to furnish their shareholders with annual reports showing their income statements and balance sheets, and every year you have to do that, and so some of us get these in the mail every year. And then it also called for quarterly reporting of income. So in Wall Street today, it's earnings time on Wall Street at the beginning of every quarter, and we all pay a lot of attention to the quarterly earnings of companies. This comes in by a government edict in the Securities Act of 1934. And see, Wall Street now, and the act also calls for the SEC to regulate the stock exchanges. It bans manipulative practices and things like that, brings up fines that, Wall Street has to be careful. Anyway, so this is, the Wall Street hates this. I showed you how the bankers didn't mind some of the aspects of Glass-Steagall because they got benefits from it. Wall Street sort of uniformly detests this regulation, and what they do is complain about it. It's the end of capitalism, end of life as we know it. But in fact, over time, it gives the public renewed confidence in the securities markets. And as I mentioned at the beginning, this is one of the great legacies of the New Deal, the confidence we have, investors have in our securities markets. And, people in the 1930s who said this is the end of the world, by the 1960s are saying this is the best thing that ever happened to us because money is flowing back into Wall Street. And, for the next half century right up to now, Wall Street has been pretty thriving in not only in our own national economy, but in the world economy. So a lot of people say this is one of the greatest benefits of the New Deal reforms was cleaning up Wall Street to restore confidence in it. And that was good not only for investors, but it was good for the firms on Wall Street. Even though Jan may complain that he has to comply with too many regulations. VanEck wouldn't be where it is today without these SEC reforms that increase people give you their money because they think you'll invest it wisely for them, Jan. I could mention other acts, the investment, at the end of the decade in 1940, we had the Investment Company Act, which registered mutual funds, and that created a sort of federal regulation of mutual funds, which became a really big thing later on in time. So I think that we're getting toward the end now. Maybe we should talk about the recovery. Some of them, if we can go back to those slides, just a little bit of quick talk on the later slides. I have to find my own. There's the bank failures. You can study that. You see a lot of banks are failing here. Many banks were not members of the Federal Reserve System. The majority of banks that failed were not even members of the Federal Reserve System. So it's not clear that the Fed, had it wanted to, could have helped them very much. But the Fed, according to Friedman and many economists, could have done a lot more to prevent all these bank failures. See, in 1933, 4,000 banks fail. 2,200 banks fail, 1,300 banks. If you add them all up, it's in the, between 7,000 and 10,000 banks failed. And a lot of them were not members of the Federal Reserve System because banks didn't have to be members of the Fed. Today, just about all of them are. But in this particular period of history, they didn't have to be. Banking Act of 1935, I should mention that because that created the modern Federal Reserve. Up until 1935, the Secretary of the Treasury was de facto chairman of the Fed, and the controller of the currency, the head of national banks, regulator of national banks, was on the Federal Reserve Board. The Banking Act of 1935 took these two political appointees off the Federal Reserve Board and created the modern Fed with 7 governors and a chairman of the Board of Governors, and changed the Open Market Committee to the 7 governors plus 5 Federal Reserve Bank chairmen. So the Federal Reserve, basically, the modern Fed was created in the Banking Act of 1935, and it's persisted to this day. The other thing that the Banking Act of 1935 did was allow the Federal Reserve to change reserve requirements. It hadn't been, the earlier Fed hadn't been allowed to do that, but the Fed got the ability to change reserve requirements. And when a central bank gets a new authority, it is quick to use it. So if we could go ahead now to, let's see, a slide. Let's go, we can pass through that executive order, but let's go to, really that's the executive order. This is the government telling you to bring your gold in, and it says you'll get in trouble if you don't turn down all your gold to the U.S. government. Let's go to the second to last slide, I think, because that follows up on second to last slide. One more, I think. Yes, this one. What you see here is reserve requirements for Central Reserve City or big banks, but the big banks. It's flat here at about 14%. The Fed did not have the ability to change reserve requirements. It got the ability to set margin requirements for stock market trading, and there's a big jump up there in 1936. But here in 1936, the Fed tries to use its new tool, and it raises bank reserve requirements in several steps in late 1936 into 1937. And a lot of people say this had something to do with had a lot to do with the 1937-38 recession that we talked about, a pretty sharp recession. The other charts in here will tell you that there was this economic slowdown there. Then I see a question from John Lukomnik. What was that question? It went away before I could look at it. Well, we can bring it up, I guess.
I can read it. I have to unmute myself.
Okay.
So
I think maybe I'm given a flavor of what this economic disaster did in terms of financial regulation and other regulation. So it basically created the modern world, and the only way we've undone it so far is repealing the Glass-Steagall separation of commercial and investment banking, and that happened in 1999. In the global financial crisis, people started saying we better bring back Glass-Steagall because when these banks could deal in securities, they got into trouble. But in fact, Lehman Brothers was not a commercial bank dealing in securities, and Bear Stearns was not, Merrill Lynch was not. So I have my doubts that it was the repeal of Glass-Steagall that caused the global financial crisis. Sure enough, Citibank and Wachovia and others did get into trouble, but that was mostly because they held these securities they were creating on their own balance sheets instead of selling them to other people. So it's not clear that Glass-Steagall's caused the repeal of Glass-Steagall caused the global financial crisis, but that people say that. But I think I should stop here and we have a discussion, take some questions. I know Jan had these things he wanted me to cover. I didn't cover the fiscal aspects of it. But I can tell you that, and one of your colleagues asked a question about that too. That was, where's the sheet I had here? Second page of that email. Well, I don't see it now, but I can tell you that basically fiscal policy, Roosevelt had a lot of deficit spending. But this did not seem to make the Depression much better. If you look at the GDP charts, the GDP is little different in 1938-39 from what it was in 1929. So there's a whole decade when the US economy had no real growth, roughly speaking. And despite all these deficits, so the fiscal policy, what we learned later on, especially due to an MIT professor named Kerry Brown in the 1950s, he wrote a piece where he showed that fiscal policy didn't work in the Great Depression because it wasn't, not because it wasn't tried, no, not because it failed, but because it wasn't really tried. And the point he was making was that had the government been at full, had the US economy been at full employment, there would not have been deficits. So Roosevelt's deficits were mainly due to the collapse of the economy. But if you had a fully employed economy, the tax rates in effect at the time would have pulled in enough money to cover the deficit. So there would have been sort of zero stimulus, you might say. It only appears that there was stimulus because the economy had collapsed so much. But given the tax rates, had the economy been at full employment, the government would have pulled in enough money to cover its deficits. The balance of the budget would have been about zero, and hence there was really no stimulus. So that's the answer to that question, Jan. You'd ask.
Yeah, Dick. to ask that question in a different way, how many people were employed by the federal government during the New Deal programs? Because we have the unemployment chart that you provided us.
I think I don't have the answer in terms of numbers, but in fact, a lot of the government program, like the Civilian Conservation Corps and the Works Progress Administration and building Grand Coulee Dam and Hoover Dam and the Tennessee Valley Authority, that actually did increase. Oh, well, the chart shows you that the unemployment rate comes down, but it doesn't come down to low levels. It comes down from, let's see, well, here's the number of people unemployed. There's the, you still have 6 to 7 million unemployed here, but that's better than 12 million. And then, of course, as the economy comes back, by 1941, before the U.S. gets into the war, you're back with only 2 million or so. Anyway, by the time the U.S. gets into World War II, the unemployment rate is already back down to about where it was in 1929. And this is due to some of these New Deal spending programs and the economic recovery. But I would say monetary policy, there was a big expansion of the money supply. The data that people have to study in the privacy of their chambers will show that the money supply actually grew there in the 1933 to 36 especially, but that was not due to Fed policy as much as it was to gold flowing into the United States as a result of the devaluation of the dollar and also the situation in Europe. Hitler was on the warpath in Europe. He would actually go on to war in 1939, but he worried a lot of people, and Europeans started sending their gold to the United States. So a lot of the monetary expansion in the United States was not due to Federal Reserve policy, it was due to gold inflows. Christina Romer has written a lot about that. So monetary policy, didn't really do a lot as policy, but other policies led to an inflow of gold, and that sort of revived the money stock. I did get some data on the national debt. Going into, we talk about the national debt today. In 1913, the U.S. national debt was 1.2 billion. In 1919, at the end of World War I, it was 25 billion. By 1929 and 30, it was down to 16 billion. Andrew Mellon and the Republican presidents in the 1920s actually cut the national debt from 25 down to 16. Then Hoover gets it up to 19.5. Hoover did some deficit spending himself. But then Roosevelt actually did so in 1932, the national debt's 19.5 billion. And by 1940, it's 40 billion. So the national debt doubled between 1932 and 1940 as a result of Roosevelt's deficits. But as I pointed out, those deficits were more a result of the Depression. Had the economy been in full employment, those deficits would have disappeared. So fiscal policy, it looked like it was doing some stimulating, but it wasn't really doing much stimulating. And that explains why the Depression lasted as long, through the whole decade, really. It was, depressed below 1929 levels. Bank stability, well, I talked about that. The FDIC came in, and that stable. By the way, the FDIC basically, or the banking legislation authorities created a sort of cartel. There were hardly any bank failures from the 1930s to the 1970s, very few. And it's because we had 363 banking. The government regulated. You all know what 363 banking is. You borrow at 3, you lend at 6. These rates are regulated, of course, and then you're on the golf course by 3. 363 banking. In other words, banking was very stable, very boring, not as interesting as it is today. And the New Deal, the banking regulations seemed to make the banking system safe, but in fact, the cartel allowed Wall Street to make end runs around it, like by doing money market funds in the 1970s and all kinds of, the capital markets took advantage of an overregulated banking system to thrive by innovating. And so that's why we deregulated banks in recent decades, because the banking system was suffering. It was losing market share to Wall Street. And so they complained about that. And that's why we had a lot of our banking deregulation, which came in the 1930s. And the disclosure philosophy, Jan likes to say, why isn't the people said after the global financial crisis, a lot of Americans said, why aren't these bankers who caused all this trouble, why aren't they being sent to jail, put on trial and being sent to jail? And the answer is the disclosures of the 1930s, all these long prospectuses. you ought to read one sometime. I think Jan's point is that nobody read them, but had they read them, they would have found out that the things they were buying were really pretty risky. One of the things is if you actually read what the government requires you to say in a prospectus when you're issuing new securities, it's sort of like, there's a small chance of this multiplied by a small chance of that, multiplied by a small chance of that. And, if these compounded probabilities come true, you might make some money by buying this security, but mostly, it's kind of to scare you into thinking you're taking a huge risk. Well, the reason the bankers didn't go to jail is because they, in compliance with SEC regulations, they told people, exaggerated really how risky some of these securities issues were. And since, if you put them on trial, they say, well, we told people that. And so you can't put us in jail. We warn people about the riskiness of mortgage-backed securities or CDOs. But, Jan's point was nobody read that stuff because it's a lot of boilerplate and scare tactics. In other words, the disclosure requirements of the 1930s helped Wall Street by keeping bankers from going to jail, because they told people what the risks were, even though the people very rarely read the prospectus very carefully. Time for general discussion, I think.
Yeah, I'd love to get people's questions. Please put them in chat. That's probably the easiest way. I guess what I would ask to start off with, Dick, is because of the SEC is oriented towards enforcing good disclosure, they're not really tasked, is my understanding, with the stability of the capital markets or the financial system as a whole. And that was kind of a criticism of them during the after the global financial crisis. What's your kind of view on the role of the SEC and the Fed? Obviously, that was addressed a little bit by policymakers afterwards. But what's your feeling about that?
Well, I think we have, we have too many layers of financial regulation in the U.S. We have federal and state authorities regulating banking, and we have the SEC and the Commodity Futures Trading Commission. We have a lot of financial regulators, and it's not always coordinated very well. And plus, point that came out of the University of Chicago 50, 60 years ago from people like George Stigler, there's a tendency of the regulators to be captured by the people they're regulating. That is, if you're regulating national banks, the controller of the currency does that. Well, he's going to favor the national banks, and so we saw some of that in the 1960s. A man named Saxon actually allowed the national banks to do a lot of things that other people objected to. And there's a view that the SEC is kind of protective of Wall Street, and the Commodity Futures Trading Commission is protective of the commodity markets. There's some truth in that. That if you're tasked with regulating and you're talking to these people all the time, you're not necessarily trying to be too tough on the regulation. You want to be friendly with the people you're regulating, and the people that you're regulating want to be friendly with you. So I think the SEC was often accused of being too passive. It did get a little more active in the 1970s when it forced the New York Stock Exchange to get rid of its fixed commission requirements. But this is only after there was a real problem, the sort of back office problem, they called it, on Wall Street. And institutional investors, of course, objected to the fact it doesn't cost you 100 times as much to buy 100,000 shares as it does 1,000 shares, but that's what the New York Stock Exchange was charging. 100,000 shares, you pay 100 times what you paid for 1,000 shares. And that didn't make any sense to institutional investors, which grew up. By the way, that's the growth of institutional investment, pension funds, insurance companies, the various kinds of mutual funds. They probably owe some of their existence to this financial regulation that came in the 1930s, which allowed them to get funds from people and invest it for them. And so the institutional investors may have been created, or they're thrived because of the 1930s regulation, and then they began to attack some aspects of the regulatory system. The SEC, up until that time, didn't complain too much about the New York Stock Exchange fixed commissions, but they finally got around to May Day 1975 when fixed commissions went out. And of course, we had an innovation after that. We had, the discount brokers came in, Charles Schwab and My friend Joe Ricketts with his TD Ameritrade, and which has now been taken over by Schwab, I guess. But so there was a lot of innovation that came from the deregulation, and Wall Street was so good at innovating that they finally got the government to deregulate banking a lot more too, commercial banking.
So I have a question for the crowd, since not getting a lot of questions in the chat, and that is, how many banks were opened their doors when FDR took office? And as you answer that, I'm going to ask Dick another question. Dick, in the last two classes, we've talked about agriculture, and agriculture was a large part of the U.S. economy. We talked about cotton, and we talked about the Midwest. The decline in agriculture prices during this period was important, and we haven't talked about it, I think. Do you have any thoughts on that?
Well, I could relate it to the banking question too. But, I just wrote a paper recently on changes in the U.S. banking structure over the last century, which is a good century to study, because the peak of the numbers of banks in the United States came in 1922, when there were over 30,000 independent banks in the United States. Today, we're down to 5,000 or less. And a lot of these banks, the small banks, they were like mom and pop banks, you might call them, out in the Great Plains, like North and South Dakota, and they were lending money to farmers. And in the 1920s, before the Depression, agricultural prices were falling. And a lot of these banks failed in the 20s. But so when you come to the Depression, you're down to about 23 or 24,000 banks. 5 or 6,000 banks failed in the 1920s. And then a lot of them are going to fail in the 1929, 1930, 33, basically. By the way, I don't think the Depression really had a lot to do with the stock market crash. The Depression really got bad at the end of 1930, a year after the stock market crash, when a whole bunch of banks began to fail. Up to that time, the Depression wasn't so bad. But when you had the first banking crisis at the end of 1930, that's when banks began to fail. There was another banking crisis in 1931 and another one in 1933. I would say you had 24,000 banks in 1929, 30, and a lot of those failed, and FDR shut them all down in the first week of his term in 1933, March 1933. And when they reopened, there were only about 14,000 banks. So maybe some 10,000 banks disappeared.
Right, but how many were open, had their doors open when FDR took office? So I'd ask
I think there were very few, actually. New York shut all the banks right before FDR, hours before FDR was inaugurated. Governor Lehman shut down all the banks in New York. A bunch of Michigan had shut down all its banks a month earlier. Other states were shutting down banks. I mean, there was just total loss of confidence. I would say, I said 1932 was probably the worst economic year in U.S. history. February 1933 was probably the worst month in U.S. financial history. People are.
The numbers close to zero, right? In terms of banks that were operating when FDR.
Yeah, that's right. I mean, most of them had shut down already, and then he just finished the job by making it national.
Right. So
then when they reopened,
couldn't get your money out. You couldn't move money around. I mean, it was
but of course that was for many people, that was only a week or two. The banks began to open, and FDR had his fireside chat, and the public sort of believed him, and shortly we were going to have deposit insurance. So, but FDR
but when he took office, the whole system was basically shut down.
Yeah, that's right. I mean, it was the bank was shut down, and whatever ones weren't shut down, he shut them down, sent in inspectors to find out how solid they were, and a lot more. When they reopened banks, there were many fewer banks than there had been. Certainly in 1930, and even probably in 1932. I think of the data my table shows that 4,000 banks failed in 1933. Most of them in the first couple months of 1933.
Well, Dick, this has been great. I guess there was a question about Smoot-Hawley tariffs, and I guess that's
Yeah.
what effect that had on this security?
Yeah, there was a theory. I forget what his name. Jude Wanniski was an economist. I guess he's probably still around. I haven't heard much from him lately. But back in the 1980s, when everyone was talking about supply side economics, um, Jude Wanniski made the point that the Smoot-Hawley tariff, which wasn't enacted until 1930, uh, actually caused the stock market crash. And so how can something enacted in 1930 cause a crash in 1929? Well, the argument was that some of the legislation was working its way through the mills of Congress, and it cleared some key uh, hurdles in August, September of 1929. And, this was bad policy, of course, for the US, which was, probably the most competitive economy in the world at that time. For the US to be raising interest, raising tariffs didn't make any sense. But there were lobbies in the United States that wanted to be protected. Farmers wanted to be protected. Various industries wanted to be protected. And there'd been a long history ever since the Civil War of, the US was kind of a high tariff country, and Smoot-Hawley raised tariffs up. Hoover went along with it. Uh, I think it contributed to the depression, but was really a small part of it. It wasn't a cause of the stock market crash, I think, and it contributed to the depression. But the collapse, most of us think the collapse of the money supply, which the Fed might have prevented. That was the key. When banks started failing right and left, the Fed should have done what the Fed's done in recent years. When we have trouble, it increases liquidity greatly, buys a lot of securities. The great global financial crisis led to the Great Recession. Bernanke thought it could have become another Great Depression, but it didn't, because the Fed injected a lot of liquidity. They didn't make the mistake they did in the 1930s and let the money supply collapse. That's a better argument for what happened. Although Smoot-Hawley did not help the situation.
And I guess going back to our friend Hamilton, he bought some securities. I think as Secretary of the Treasury, the Fed was not involved at all in the equity markets during this time period.
Oh, no. But of course, the financial conditions, the interest rates and so on have an impact on
No,
the
no, no,
stock
of
market.
course, but
Yeah.
not direct. Yeah, yeah.
Yeah, not direct. But the Fed did reduce, after the stock market crash, the Fed did reduce interest rates. The charts show that. But it was kind of too little too late by that time.
Yeah.
Uh,
Did they have the ability? Did the Fed have the ability to buy if they had wanted to bonds or
Oh yeah, they discovered, the Fed discovered open market operations almost by accident. When it was formed, it didn't have a big balance sheet, but then by the early 1920s, they started buying security, and they noticed that when they bought securities, basically just to, have a balance sheet without any great policy intent, they noticed that the financial conditions seemed to ease and the money market seemed to ease when they bought securities. So then, after they noticed what was going on in the markets, they said, gee, I guess they figured out that if we buy securities, that creates new money and that eases market conditions. By the same token, if we sell securities, that tightens up the markets. And that was the beginning of open market operations in the 1920s, but it was sort of stumbled onto. It wasn't done by any sort of theory. And by the 1930s, they could buy securities, and they did buy securities. I mean, we've seen doubling of the central bank balance sheets in the 1930s. There were some, the doubling of the Federal Reserve balance sheets at various times. So yeah, they by the 1930s they had a federal open market committee which set policy, and they knew what would happen if they bought and sold securities.
Dick, we have a question relating to commercial banking. I'll put it in my own words. And the regulation of commercial banking means that there can be activity, but there's always activity outside of the commercial banks, like the mortgage crisis and the securitization of mortgage loans. Is there anything that you see now that worries you in happening in the financial markets?
Um, I mean, there are a lot, Wall Street's very innovative, and one of the latest fashions is what are called SPACs, right? Special Purpose Acquisition Companies.
Yeah.
And, this strikes me as one of these innovations that could cause trouble. People are just handing money over to smart people on Wall Street and saying, go out and find some company to invest this in. I trust you, to find a good investment that'll give me much more money than I can earn on other things. And this is the newest new thing, I guess, and it might work out, but it might lead to disappointments as well. So I don't really worry about it that much, but I will say that Wall Street is very innovative in coming up with products, and sometimes they, can get Wall Street into trouble, like some mortgage-backed securities and CDOs did 10 years ago or so.
Right.
Uh,
In March and April, another question, the Fed used the sort of playbook of the financial crisis in terms of getting involved in buying fixed income securities and even fixed income ETFs. Any observations on that?
Well, we want to have an independent monetary policy, and monetary policy should differ from fiscal policy. But if the Federal Reserve, they started to buy corporate bonds and, as you say, ETFs and things like that, this was to inject liquidity into the market. But in fact, when the central bank does that, it's making a policy decision. Let's say when it buys mortgage-backed securities, basically it's making a decision is that the housing sector should be favored over making aluminum or making steel or something like that. So these are like political decisions that I worry a little bit if the Fed is buying, private securities, it's really making a political decision to support that particular sector of the market. And it opens itself up to the criticism that you guys weren't elected, but you're making policy to favor some industries over others. So it could lead to a backlash against the Federal Reserve. And the Fed has lasted for more than a century now. But early in U.S. history, we had two banks of the United States that maybe David Cowan talked about that when he talked about Hamilton. And these were pretty good banks. They were good, maybe they were better central banks than the Fed even, but they were politically, they were also commercial banks as well as central banks. And that meant they competed with the other state banks, and the state banks ganged up on them and got Congress not to renew their charters. So the Fed, is running a little risk when it picks winners and losers. The losers aren't going to like the Fed picking winners like housing or ETFs.
Yeah, that's interesting that there wasn't more backlash this year. So I was going to make that the last question, but there's one more that's begging to be asked, which is, what do you think about Bitcoin?
Bitcoin, I read it. I think Jason Zweig, my friend at the Wall Street Journal, had a column the other day about some company that had a huge cash balance and they decided to invest most of it in Bitcoin. I think it's risky. I mean, I don't think Bitcoin is really a coin. I mean, it's sort of a speculative investment or something like that. It's not really money, and so I'm very skeptical of Bitcoin. But what I would say is that if you're interested in digital currencies, we're seeing now it happening, and some of us predicted it a couple of years ago, that if digital currencies make any sense, the government will get involved. The central bank will get involved in producing a digital currency, and that will probably put, Bitcoin and Ethereum or whatever they're called. They'll have a hard time competing when the United States government or the Federal Reserve creates a digital currency. So I would stay away from Bitcoin, but that company thought they put a $500 million into it, I think,
It's
because
worth
they're
more
worried
than
about
that now.
inflation. Yeah, they worry about inflation. They said, I worry about inflation too, but worrying about inflation might make me buy tips, not Bitcoin.
Good enough. Well, some people don't trust the government at all, I guess. So they want to get far away. Anyway, Dick, thank you so much for covering so much important history and for kind of giving us really great charts. As people have seen the other classes know, it's usually me that has to find the charts, and so I'm really happy to speak with a historian that. And I should note that not only did you provide the charts, but you've throughout your career created many of these, collected the data behind the charts.
Oh yeah.
Really contributed a lot to our understanding of the history of financial markets. So it's really a pleasure to have you with us today, and thank you.
You're welcome. I enjoyed visiting with all of you.
All right, take care.